The Nikkei 225 just collapsed 3.74%. That's the sharpest single-day plunge since the August carry trade meltdown. But here's what nobody is telling you. While retail panic hit maximum intensity, institutional flow data shows hedge funds are not selling into this. They are patiently loading dry powder right at the edge of the cliff. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, with entries, stops, and risk-reward mapped out on screen. If you're still holding a losing position or waiting on the sidelines, this is your session blueprint. Right now, Nikkei is in a pure risk-off cascade. The 5-hour trend is a strong sell. The 1-hour trend is a strong sell. Momentum is accelerating lower. But the daily chart is still neutral, and the weekly and monthly remain strong buys. That tells you exactly what is happening. We are inside a high-speed correction within a structural bull market, and these are the conditions that wreck both panic sellers and premature dip buyers. Write this number down. If we break and hold below 63,716, the entire weekly bull structure resets, and we are no longer in a correction. We are in a bear market unfolding. That is your invalidation for any long exposure, and here's the herd insight. The herd is euphorically short. Retail positioning on Japan 225 CFDs has exploded to a 3-month high on the short side. Meanwhile, the BOJ has stayed silent, and yen strength is leading this decline tick for tick. When everyone leans one way, the market has a habit of snapping in the opposite direction. The single level that flips this bearish bias is a daily close back above 64,171. I'll keep coming back to that number. Let's walk the charts top down, because structure always rules. Starting on the weekly, the 200-week moving average sits way down at 54,472. That is the long-term anchor. We are still well above it, which is why the bull case for the next quarter is not dead. It is simply being tested. Drop to the daily. The 20-day moving average, at 64,661, is now overhead supply, acting like a brick wall. Price tagged it from above 2 sessions ago and was rejected violently. The 50-day moving average at 62,108 is still rising but is far enough below that a swift move to retest it is not just possible. It would be a textbook reversion in a trend that's gone too far too fast. Now the 4-hour chart, and here's what most traders miss. Before this collapse, we printed a textbook negative divergence. Price made a lower high around 65,300, but the MACD histogram made an even lower high, showing that buying momentum was completely exhausted. That hidden divergence was the early warning. The 4-hour MACD is now deep in bearish territory, with the signal line accelerating below zero. There is no bullish cross insight yet on the 60-minute chart. The moving averages are in full bearish alignment, the 20-period and 60-period MA both sloping down. Every minor bounce toward the 20-period MA is getting sold. Immediate resistance is 63,943. That level used to be a support floor during the last consolidation, and now it's the line in the sand. Above it, we have 64,095, which aligns with the Asian session high before the plunge, and then 64,171, which is the last structure high on the hourly chart on the downside. The first support is 63,716, the June swing low. Below that, we have 63,640, a volume node, and then the real trapdoor, 63,488, the value area low from the previous week. If 63,488 breaks on volume, we are going to see an air pocket down to 62,500. Possibly even 62,108, the 50-day MA. That's where I'd expect a real institutional bid to emerge. Now the cross-asset linkage. Gold is moving tick for tick with the Nikkei collapse, but inversely. Real yields are collapsing as the yen rallies, and that yen rally is the Nikkei's kryptonite. Every 10-pip drop in US dollar to Japanese yen is wiping roughly 80 to 100 Nikkei points off the board. We are seeing a direct carry trade unwind in real time, magnified by the AI trade imploding. Advantest, Tokyo Electron, SoftBank, those names didn't just dip, they got annihilated, and that's dragging the entire index. Yesterday's Iran strikes ripped through markets, but the deeper story is this. The AI rally that powered the Nikkei to multi-decade highs is unwinding, and it's happening against a backdrop of a suddenly hawkish BOJ. The market is now pricing a 15 basis point hike in July with over 60% probability, and every hawkish whisper sends the yen screaming higher. When the yen strengthens, Nikkei's export machine gets crushed. That's the 1-2 punch. Institutional positioning confirms this. ETF flows out of Japan equities accelerated today, but the pace of outflows is actually slower than during the August shock, which suggests large allocators are not yet panic dumping. They're watching 63,700 like a hawk. If that holds, they redeploy. If it doesn't, the systematic selling programs kick in. Options gamma is heavily concentrated at 63,500, making that a magnetic level for Friday's expiry. For the next 1 to 2 weeks, my directional lean is further downside pressure, targeting the 62,500 to 62,100 zone. The only thing that invalidates this completely is a daily closeback above 64,171. If the Nikkei reclaims 64,171 on a closing basis, the entire bearish structure collapses and we go back into range. Here's a quick interaction trigger. Do you think Nikkei retests 60,000 this month? Comment yes or no right now. I'm tracking the consensus, and I'll reveal tomorrow if the crowd is positioned wrong. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm giving you the sniper, the active, and the aggressor plays with exact numbers. Strategy 1, the sniper, conservative. This is your high probability fade. The setup is a short on a confirmed rejection at resistance. As long as the 1-hour candle closes below 63,943, we are in a sell-on strength environment. The exact trigger, place a limit order to sell at 64,095, right at the next resistance, with confirmation that a 1-hour bearish engulfing candle appears or price simply stalls there. Your stop loss goes above 64,220, leaving a buffer above the 64,171 invalidation level. We do not want to be short if price punches above that zone. Target 1 is 63,716, the first support. Target 2 is 63,488, the value area low. That gives you a risk-reward ratio of roughly 1 to 3.1. This trade is completely void if the 4-hour candle closes above 64,171. No exceptions. The sniper, conservative, entry, 64,095, limit sell, 1H bearish rejection, stop loss, 64,220 take profit 1, 63,716 take. Profit 2, 63,488 risk, air reward, 1:3.1 are invalidation, void if 4H close above 64,171 strategy 2, the active trader, standard. The active trader wants to ride the momentum breakdown itself. The plan is to sell on a clear break and retest of 63,943. Once we get a 15-minute close below that level, set a sell stop at 63,930, anticipating that any minor bounce back to that old support becomes fresh resistance. Your stop loss sits just above the round number at 64,010, so a stop at 64,010. Target 1 is the same 63,716, but here's the key. Once target 1 is hit, move your stop to break even and let the rest run to target 2 at 63,488. You can also trail the stop on the 1-hour candle low above 63,700 once price tests it. Initial risk reward is about 1 to 1.5, but with the trailing stop it becomes a free runner. The setup is invalidated if Nikkei reclaims 64,100 before triggering the active trader, standard, entry, 63,930, sell stop after 15 minutes close below 63,943, stop loss, 64,010 take profit 1, 63,716, then move SL to BE, take profit 2, 63,488 risk, air reward, (1:1.5 initial, free run thereafter invalidation. Void if price trades above 64,100 pre-entry. Type your Nikkei range for tomorrow in the comments now. Let's see who's aligned. I read these, and the closest prediction gets a shout out in the next video. Strategy 3, they. Aggressor, high risk. This is the counter-trend dip buy for those who can lose small and manage risk aggressively. The idea: the first touch of 63,716 support often produces a violent reflex rally, especially with the herd massively short. The trigger is a bullish pin bar or a double bottom on the 5-minute chart at exactly 63,720. Enter long at 63,720. Your stop loss must be brutally tight, at 63,590, below the next support node. Target 1 is 63,950, just above the broken resistance 63,943, because that level will be tested from below. If that target is hit, tighten the stop to entry and hold for target 2 at 64,095. That's a high-risk 1-to-4 reward setup, but only if the price structure confirms. If 63,716 fails, you're out immediately with a small loss. This trade is only for those who can react in seconds. Do not chase this blindly to the aggressor, high-risk, entry, 63,720, by limit, 5M bullish pin bar required, stop loss, 63,590 take profit 1, 63,950 take profit 2, 64,095 risk, air reward, ~1:4.2R, if both targets hit, invalidation, void if 5M candle closes below 63,716 never risk more than 1 to 2% per trade. No positions through high-impact news events, especially the Tokyo Open gap risk. Stops are non-negotiable. This is how you survive to trade the next big move. Volatility is a tool, not an enemy. If you respect your risk, let's sum this up. The single most critical level for the next session is 63,716. A close below that opens the trapdoor to 62,000 and beyond. If it holds, and we get a daily reclaim of 63,943, this becomes a fierce short squeeze rally. Tomorrow, I'll be laser-focused on the Tokyo opening auction and any BOJ comments. The intervention ghost in the yen market is the wildcard that could flip NIKKEI in seconds. If you want the full breakdown on US dollar to Japanese yen and the carry trade reload, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.